After a decade of knockout returns, the party might be coming to an end for emerging market stocks and bonds. Sheila Dharmarajan has the latest Bloomberg analytics on why things are changing, and it's a real 180 for these emerging market assets from last year.
Now, absolutely, Scarlett. I mean, you name it, stocks, bonds, emerging markets have had a great run over the past decade. Let's look at emerging market stocks. Over the past decade, these stocks have returned 154% compared to only 2% for developed countries. It's also been a decade of outperformance as bonds as well. 171% return compared to only 72% in developed markets. Now, looking ahead, though, a lot of the factors that drove emerging market stocks and bonds no longer apply. Let's look at GDP growth, for example. On average, was about 5.2% higher for emerging markets versus developed markets. But fast forwarding to now, that gap is shrinking, only 3.8% higher. What about valuations? Nowhere near as cheap as they were before. So for stocks, for example, price to earnings for emerging market stocks were 12 times lower as compared to the U.S. back in 2002. Makes sense, high risk, low price. But when you fast forward to now and see what's happening, you can see that discount is almost gone, Scarlett.
All right, high risk, low price, presumably the risk of the emerging markets is a lot lower now than it was before. Can't you make that argument?
Well, you know, that's actually where it gets pretty interesting, because when you start to look at conventional measures for defining an emerging market, GDP per capita below $10,000, for example, most emerging markets are actually still below that level. So, for example, Mexico, China, Brazil, Turkey, for example, all below this $10,000 GDP per capita threshold. And also, when you look at that in comparison to their sovereign spreads, relatively low sovereign spreads. So in the context of valuations, investors aren't getting rewarded to take on the risks of relatively poor and riskier countries. But I do want to point out a standout, Argentina over here. You can see it's over here on the chart. Now, what's happening here is that Argentina actually is a relatively wealthy country, but when you look at the sovereign spreads, relatively high here. So investors are actually starting to get paid nicely for taking on a risk for a market that's much further up along the economic curve. And of course, Scarlett, that is a potential opportunity.
All right, so watch Argentina. Thank you so much, Sheila Dharmarajan, on the emerging market stocks and bonds.